Hello there, Dana here with your weekly options trading recap. Today I am going to demonstrate the gap fill up strategy that presented itself today, April the 16th. As you know from our previous videos, for the gap fill up strategy, there are two important price points that we need. First, we need the lowest price of the previous trading day, which was in this case April 15th. The low price was $536.81. We also need to know the open price for today, April the 16th, which was $531.68, which creates the gap. In this case, that gap was approximately $5.13. As you know, this strategy seeks to capitalize upon probabilities that the price of SPY will increase to fill the gap. Again, the gap is when SPY opens lower than the previous day's lowest price. And as you know, SPY is the ETF for the S&P 500. So on April the 16th, when price gapped down, around this point, I purchased the 532 strike price, a call, because again, the theory is that SPY will increase in price to fill that gap, which is why I purchased the call with the expiration date of April the 21st, because I always buy time. And at the time of purchase, each contract was an average of $595 per contract. Now let's see how this trade unfolded for us. I'm currently on the 1 hour time frame simply to demonstrate for you the price movement for this strategy. You see around the second hour of the day, price was increasing and then continued to pull back. Let's keep going. Around the 6th hour of the trading day, you see that price increased to meet our target. And again, the target here was $536.81. At this point, the same contracts that I bought were selling at an average of $778 per contract before taxes and fees. So before we do the math on our profit, I want to point out how quickly this price moved. Dropping down to the 1 minute time frame solely to demonstrate how quickly this moved. You see this long green wick about the 6th hour of the day. This is how quickly we reached our price target, and that price pulled back. This is why you want to make sure you have an automatic exit, because imagine if you had just gotten up to get a drink of water or just to answer a telephone call, you would have missed your exit. And when it comes to execution, SPY particularly can move quickly. So if you have already identified your price target and when you're going to exit, which you should do under this strategy, if you have that automatic exit, you're out and you're in profit, and you can do that math. You're up about $183 per contract, or 30% return on investment before taxes and fees. I hope this has been helpful to you. Remember, know your strategy, know your entry, know your exit, know your strike price, know how much you're willing to pay and how much time you need to buy in order to be on your way to be a consistently profitable trader. Until the next time, be disciplined. Take good care. Goodbye.